2002. She's been an academic fellow already at the IASB in 2011 and 12, and has her PhD and is currently a professor at the University of Western Australia. She's also a very productive researcher, as I know from her being a long-time colleague and one of the few people with an academic background to have served on the IASB board. Another one of those rare species is Tom Scott, our next panelist today. Tom is also a board member, and he's also been appointed in 2017 and will be on the board until 2022. He's a professor. He used to be a professor of accounting at the University of Waterloo in Canada, and has been a member of the Canadian Accounting Standards Board for a number of years, starting in 2003. I'm also welcoming Peter Joos. Peter is a professor of accounting at INSEAD, and he's also the chairman of the European Accounting Association's Financial Reporting Standards Committee, which is our organization that that accompanies and comments on standard setting proposals and projects by the IASB and EFRAG, for example. So in terms of our format today, I would like to remind you that this event will be recorded for later reference. It will be posted on our European Accounting Association Accounting Resources Center. We would very much like for you to pose us questions and ask questions to the panelists, or make observations, bring your research insights to bear on these topics. And if I could ask you please to post your questions into the chat forum, and if possible, indicate if there is a specific person that you would like to take the question, please indicate who this question is for. For later follow-up questions or feedback, I've also posted into the chat Anna Simpson's email address, which is asimpson@ifrs.org. So please get in touch with Anna for any follow-up comments or questions. I think without any further ado, I would like to start us off. Really very much looking forward to this event. The event is separated into 3 sections. The first section deals with the issue of subtotals in the income statement, in the profit and loss statement. That is one part of the exposure draft. The next section will deal with disaggregation of performance in the profit and loss statement. And the third section will be dealing with management performance measures. All of these sections have about 40 minutes assigned to them. There will be about 20 minutes of presentation and about 20 minutes of Q&A. So please have your questions ready. And now I want to welcome Aida Vetreniak to start us off on the subtotals topic. And welcome, Aida, floor is yours.
Thank you very much, Thorsten. And just like you said, good morning, good afternoon, and good evening. I've seen already messages in the chat box indicating from all different time zones people are joining us. And I'm actually not going to start right now, because I wanted to ask Tom if he may just give us a little bit overview, high-level overview of the project, and then I'll be happy to run through the proposals relating to the subtotals. Is that okay, Tom?
Sure. So, good day, everyone, and let me welcome you on behalf of the IFRS Foundation and my colleagues. We're delighted to have the opportunity, and we're delighted to be able to have your feedback. So, in particular, I'd like to encourage you, if you do have thoughts, to take advantage of Anna's email that was given earlier, and is put up in chat if you have stuff to send us. So if we go just to the, what we're aiming here at is looking at improving the general presentation of financial statements and disclosures. And in particular, we're emphasizing the statement of financial performance, or the income statement, although we are making some small changes to the cash flow statement and even smaller changes to the statement of financial position. But the genesis of this project, the most recent genesis, if we could maybe go forward a little bit on the slides. So actually, let me just, Thorsten mentioned, but I'll repeat again, it's predominantly the income statement that we're looking at. And what we're trying to do is essentially improve the information for users. And we're going to do this by defining subtotals, some subtotals that have been in demand for a long time. We're going to work on disaggregation, producing what users refer to as better granularity. And I guess if I was in information economics, I'd say a finer information set for users. And we're also going to be taking a look at management performance measures. And there's significant demand to improve the consistency and the discipline in providing these. So we're going to look at all of those three things plus some other issues. If we could go forward one more, please. The genesis of the project was, the most recent one, as I said, was in the when we did our agenda consultation in 2015, there was significant feedback that we needed to do something in particular on performance reporting. And this isn't new. Many of you are probably aware there was a major effort by the FASB and the IASB, roughly 10 years ago to make major improvements. And they almost got all the way to an ED and then they dropped it. We're confident this time that we will get somewhere, and hopefully with your help we will. So we've worked very hard on it. We published our exposure draft in December 2019. We're seeking feedback because of the COVID crisis. We've extended the period of consultation to the 30th of September, and there will be a new standard to replace IAS1 when we're finished. And one of the things we're doing in addition to the outreach with users and our own work is we are doing a lot of field work where the ideas are being tested with organizations, and we're doing Anna has done an academic literature review for us, and we've looked at academic literature throughout, and we would welcome more if you have things that you think are pertinent. So if we go one more, please. Slide, that is. So we're going to come out with new presentation disclosure requirements. There'll be amendments as appropriate to other standards. Again, one more. And the key proposals are the defined subtotals. Users have asked that there be more subtotals. They've asked for consistent definitions of subtotals, so we're working on that. Level of disaggregation is important. I think if you, again, look to information economics and the concept of fineness is people want better partitions so that they can sort out the performance of the entity in a clearer way. And the non-GAAP measures that have, to some degree, filled possible voids, we're looking at improving the consistency and the discipline in them, in particular by bringing an audit in. And so that's sort of, I think, a nice complementary thing to what we're doing on the statements proper, and we're going to bring that into a note. So if we go just one more. So the next thing is going to be subtotals. And so we're going to go through all these things. And essentially, Aida will do the first thing, subtotals and disaggregation. And Tarka then will pick up the management performance measures. And Anna will come in with comments on research that's influencing the project. So Aida, if you would please take over.
Thank you so much, Tom, for that introduction, and hello again. So as we said, the way we're going to run this session is we're going to discuss topic by topic. So I am now going to present proposals relating to subtotals, and then we're going to invite questions on that and have a sum of discussion. And we also have some polls for you. So when I finish presenting this section, I'm going to release a polling asking you a few questions for, with your views about this specific part of the proposals. So let's look at what this is all about. And maybe if we can go to next slide. Thank you so much. So this slide is just reminding us of why the board is proposing, why is the IASB proposing new subtotals in the statement of profit or loss. As Tom said, this is really in response to significant demand we had from users of financial statements. And the reason there is such a significant demand for this is that current practice is really that companies provide lots of additional subtotals in the statements, and these subtotals are not defined, they're not required by IFRS standards, but they are permitted or encouraged even in IAS1. And as a result of that, there's a huge diversity in practice. So to help board when we were doing redeliberations on this project, we looked at sample of 100 companies from across the world to see what they were doing with respect to these subtotals. And we found that of this sample of 100, we found 63 companies using operating profit subtotal. And then we said, let's see how they define it. And we found at least 9 different definitions of this operating profit. And I say at least 9 because in some cases, I couldn't even ascertain from financial statements what was included or excluded from this subtotal. So it wasn't even that clear. And on the right hand on the slide here, you see some examples of things that are often classified differently between companies. And these are 2 most common ones, I would say. One is the share of profits or loss from associate and joint ventures. So in other words, the result from equity method accounting. And the other one we have seen significant diversity in practice is classification of unwinding of discount or interest on pension liabilities. And this one is in particular where users have been very vocal and saying, just tell them where to put it. I'm so tired of having to look through financial statements, and the first thing I have to do is figure out where is this classified. So in response to that, IASB is proposing some additional subtotals that would be required to be presented by all companies. And we find this is best to talk through using an example. So we have an illustration on the next slide that I will use to explain this proposal. And so what the proposal is basically is to require companies to classify all income and expenses in profit or loss into one of the 4 categories. And the categories you can see here in the boxes on the right hand side of the slide. And just a reminder that the income taxes and discontinued operations are existing categories in IAS1, and they are not affected by these proposals. So what goes in income taxes and discontinued operations is going to remain the same, and also OCI. So this project really is about classifying items. So this part of the project is about classifying items above profit or loss. And just to note, it's also not affecting when items are recognized and how much they're measured at. So this is a pure classification. And just a final also health warning. So we find it's best to explain proposals using an example, but this example illustrates the subtotals that will be required that you see here highlighted on the slide, the 3 subtotals. And the rest is really just illustration. So please don't read the line items that you see here as required line items or as only line items that companies would present using the proposals. We just use this to illustrate. And furthermore, this is illustration of what we call general corporate model, and we have some tweaks into how these proposals would apply to financial institutions such as banks, insurers, and the like, and I will talk about that in a moment. So now I've given you all these health warnings. Let me tell you what these proposals are. So let's look at operating first. And as I said earlier, we found operating profit is one of the most commonly used subtotals. And I would say it's really the star of the show in terms of the proposals in the exposure draft. And the IASB, the board's objective with defining operating profit is to ensure that it captures all income and expenses from what we describe as entities' main business activities. So if you have a key performance indicator, it ought to be captured in the operating if this is, this is your main business. But the way the board has gone about defining what goes into operating is using, I would say, default approach. So in other words, what the exposure draft proposes is that entities would look at income and expenses and see if they meet definitions of these other 3 categories below. And then anything that doesn't meet specific definition of these other three categories is by default classified as operating. Some refer to this also as a residual approach. And why is this approach proposed? Well, there are several reasons for that. One is that it was felt that it would give most consistent application, in that it's in a way easier for companies to determine what is investing or financing, and then by default anything else gets operating, so you don't get this, you get less inconsistency between companies. This approach also avoids having another category that wouldn't really have an objective. If the operating were defined directly or positively, then you would have to have somewhere else where you put things that don't meet any of the definitions, and that really wouldn't help comparability with users of financial statements. And then finally, its response to a philosophy, I would say, or the view that by default anything that companies do is operating. So it is really felt appropriate that this is a default classification, because other activities are almost as exception, but by default everything is operating. So this is how operating has been defined. And let's look at now at maybe the category at the bottom, the financing. I think this is maybe quite intuitive to understand. Above financing, we have proposed subtotal of profit before financing and income tax, which is the objective of this really is to help users compare performance of different companies regardless of how they're financed, debt, equity, or combination of thereof. So what is in this category? You probably wouldn't be surprised. The main things is interest on debt. So this is captured in the line item that you see here described as expenses from financing activities. But we also have a couple of more things in this category. One is the effect of time value of money, so unwinding of discount on liabilities that do not arise from financing, so non-financial liabilities. So you find things like unwinding on discount on pensions and provisions here. This was a little bit controversial, I would say, because there isn't a consensus view as to whether these items are financing or not. But our discussion with users of financial statements indicated that most of them treat them together with other financing items, and that's how they analyze them. And everybody had a preference. Remember the previous slide I was showing you, everybody had a preference that there is a single location for these things. So even if they disagreed, those users said they prefer to know where it is, and then they can adjust for it if they need for their analysis. And then the final item that is in this category, you don't see it in slides. In this example, we assumed it's immaterial, but if it was material, it would be presented separately, and this is income from cash and cash equivalents. So financing category is generally about liabilities. There are liabilities there unless your pension plan is in surplus, and additional exception is cash and cash equivalents, and they have been classified here again. I would say somewhat not controversial, but maybe not unanimous decision here. But the view was, if we want to do the kind of ideal classification, what you would need to do is ask companies to separate their cash and cash equivalents between those that serve working capital purposes, that would perhaps be in operating, and those that serve kind of part of treasury function that are like excess cash and cash equivalents that are used to offset debt and the like. But this approach, I think the conclusion was really it would be too costly compared to benefits that it would give users of such classification. And therefore the proposal is that cash and cash equivalents is taken as a proxy of excess cash and cash equivalents, and therefore the entire thing is classified as a financing on this cost-benefit basis. So that is financing category. And then if we go up, we look at investing. And what is this about? This is really about separating returns from those assets. So this is about assets where these returns arise, what we say, individually and largely independently from other resources of the company. So these users again have told us they would like to analyze these separately from entities' operations. And in a general corporate, the things you would find here are returns of various financial instruments, except for cash and cash equivalents, which we just discussed. And you would also maybe find rental returns and fair value changes on investment properties. So just a reminder, so this is the what we call general model for corporates. Again, banks and insurers and the like will do things a little bit differently. So that is investing category. And then we are left with this thing squeezed in between operating and investing, and it's a new concept of integral, associate and joint ventures. And maybe if you go next slide, it's easier to explain how this came about. So you might remember from my introduction, the share of profit or loss was one of these items that is commonly classified differently between different companies in our research. And we had lots of discussion, or the board had lots of discussion around where to classify share of profit or loss from associate and joint ventures in this new model, in these new categories. And there seemed to be kind of two, I would say, somewhat competing views. And one is the view from investors we speak to, or we have spoken to in preparation for these decisions, and their view was that any share of profit or loss, wherever it is, should not be in the operating profit, because share of profit or loss is a net number. It's after tax, it's after finance costs, and what investors like to do with operating profit are things like margin analysis. And for share of profit or loss, you know, that will just mess up their margin analysis. There's no revenue number associated with associate and joint ventures in P&L, and then there is also other expenses that are you know, not really relevant for the margin analysis they're doing. So they say, whatever you do, don't put it in the operating. On the other hand, we have companies say that they have a lot of associates and joint ventures that they view as closely related to their main business activities, if you like, an extension of their business. And sometimes they classify them in operating, and they would like to do so, or as close to operating as they possibly can. So balancing these two views, what the proposal is in the exposure draft is to require entities to separately identify associate and joint ventures between those that are viewed as integral to entities' main business activities and those that are not integral to entities' main business activities. So those that are not integral are essentially those that meet definition of income and expenses from investments. So the returns arise independently from entities' other main business activities. And then integral ones would have their own little category, which we have seen on previous slide, of integral associate and joint ventures. And then there will be additional subtotal that would add the results of operating profit and these integral associate and joint ventures. And this was a way as a balancing needs of users and preparers. And maybe just to add, it's somewhat controversial proposal still, I would say, and in our outreach we're getting lots of questions around application, and users are saying, at best, if you have to have it, have it. We don't have a great support from users, with some exceptions perhaps. And there's also concern that this subtotal of operating profit and share of profit is perhaps not really meaningful subtotal, because it mixes, again, remember the problem with share of profit being post-tax, post-finance cost and all of that. So I suspect this is something we're going to have to discuss a lot with the board. So I'm also interested, and I think when I launch the polling, I think we might have a question on this for you as well. But before I pause for questions, I just want to maybe go through the rest of this and explain a little bit about how these proposals would apply to, you know, a bank or an insurer. And if you go maybe next slide, just to illustrate the principles of that. So if we were to just stick with that main general model for all companies, what would happen is that the bank would be required to present interest expense in the financing category. And as we know, banks like to present net interest income. It's one of their key performance indicators, and that wouldn't be possible using this, excuse me, general model. So it was clear that the general approach wouldn't really work. Similarly for insurer, investment returns are an important part of their performance indicators, and they would have to be presented in the investing category. So again, it didn't seem that that outcome would be useful for these types of companies. So what the board has proposed is a principle-based approach where, depending on entities' main business activities, they would be required to classify income and expenses that would otherwise be classified either in investing or financing categories and move it into the operating. So we have the principle that leads classification of financing into operating on the left-hand side. So you see the green boxes, and this is the principle based on main business activity being provision of finance to customers. So this would capture banks. This would also capture perhaps a manufacturer that provides finance to customers as part of their main business activities. And for those companies, they would be required to move income and expense from cash equivalents and income and expenses from financing into the operating. And there is little tweak here in that when considering this proposal, the board considered the fact that expenses from financing, so interest on that and similar expenses, they relate both to financing of your provision of finance to customers, but they also finance the rest of your business potentially. So there was a discussion as to whether only a portion that relates to provision of finance to customer should go to the operating or all of it. And the feedback we got from some companies, in particular conglomerate banks that do investing, financing, and combination of activities, that for them it would be extremely costly to separate finance costs that relate to their loans to customers versus other finance costs. And this is how it came about that the board proposed accounting policy choice that such companies can make as to whether they move only items that relate to provision of finance to customers into the operating, or whether they move all of the items into the operating. And the idea behind the choice is that somebody like manufacturer that provides finance to customers, they would be able to easily separate those items and only move those that relate to the financing arm into the operating, whereas banks wouldn't have to separate that. I think we might have lost slides in the process, but I'm hoping that that is, somebody's looking at that, and I'm just going to continue talking through this. So I've just explained how the proposal would apply to those that provide finance to customers. So they would move expenses from financing into operating. And then we have a second principle which relies or questions if the main business activity is to invest in assets that generate returns individually and largely independently. You're probably getting familiar with this definition, so definition of income and expense from investments. So those for whom this is main business activity or something they do in the course of the main business activity, then they would be required to move those that income and expenses up into the operating. And this would capture somebody like insurer or investment company or real estate company, for example. So they get their key performance indicators in the operating. And thank you, Peter. And I think it's a good now to maybe just illustrate this with an example. And I think on next slide we have example of what this would look like. So we can see here example of investment and retail bank. Again, please don't pay too much attention to line items. This is just illustration. But what we see here, so interest expense has gone up into operating. You can see it as a green, so it's not in the financing. And then items in trading income, investment income have been moved from investing category again into operating. So there is nothing we assumed into the investing category in this particular example, except for non-integral associate and joint ventures. And then final note that in the case where entity moves expenses from financing, all of them into the operating profit, then they wouldn't be presenting profit before financing and income tax subtotal, unlike all other companies to whom these proposals would apply. So I think that is all I wanted to say on these proposals. And again, before we stop for questions, I just want to invite Anna to just give us a brief overview of your work, Anna, on literature review relating to this part of the proposal.
Thanks, Aida. And good afternoon, everyone. I'm very pleased to be here. So what I'm going to do now is I will provide a very high-level summary of the research that we have found, which is relevant to the proposals. And please, if you're working on a paper that is related please do send it to us. I have provided my email in the chat room, or any thoughts, reflections, anything that is related to the literature, sent to me or indicate by question. So what does the literature, the academic literature, has in terms of evidence that is relevant to the proposal, and particularly to the subtotals? The first thing that emerges is on operating profit. The evidence is that this is a useful measure of firm performance for investors, and this is based on evidence from academic studies that show that it is associated with stock prices and returns, and it has predictive ability for future firm performance and for expected stock returns. Overall, the inclusion of operating profit in the income statement is increases the informativeness of the statement of profit or loss. Now, when we consider the evidence on the usefulness of operating profit, it is important to bear in mind some caveats. And the first one is that companies that have decided to disclose operating profit in their income statement may have done this, their decision may be endogenously determined, in the sense that they may have decided to present operating profit just because it is a useful measure, and therefore this influences the findings of the studies. And another caveat that needs to be borne in mind is that the definitions of operating profit vary by company, and therefore when a study looks at a sample of companies, all these, the operating profit of these companies would not be with a uniform definition. So this may in a way influence the inferences and the results to an extent. So with these two caveats in mind, the main takeaway is that operating profit is a useful measure of performance, and therefore this provides some support for including it as a subtotal. The other point that emerges from the literature review is on the source of income and expense. Sorry. And there is evidence in the academic literature that the investors take into account the source of income and expense, and particularly the operating financing distinction is very important. The academic literature shows that this distinguishing between operating and financing activities on the statement of profit and loss is very useful for analysts in their valuation models. And it also has a conceptual ground, because it separates the value generation and value distribution activities in the firm. So this evidence provides some support for including more subtotals, defining subtotals on the statement of profit and loss in general. There is also some evidence with regard to the earnings before income and tax measure, which is the closest equivalent to the proposed profit before financing and income tax. And a few studies look at this measure and show that it is quite frequently used. A large proportion of the companies examined use this measure to communicate information to investors in press releases. And not only that, there is a study which looks at the location of this measure within the press release, and shows that companies usually disclose this measure quite prominently in among the first at the top of the press release. So this again provides some support for the proposed subtotal profit before financing and income tax. And finally, on the issue about separating the integral versus non-integral investments, Here the evidence is fairly limited, the direct evidence, and it is a bit mixed. Because on the one hand, there is some evidence from the finance literature which shows that investors differentiate in their market reaction to announcements between alliances and joint ventures that are strategic in nature and alliances and joint ventures that do not have underlying synergies. So this, to the extent that the distinction between strategic and non-strategic alliances maps into the proposed integral versus non-integral distinction, there is some support that this distinction is useful. However, there is a more recent paper based on a sample of large Australian companies where they examine practices of companies and how they report the profits or loss from associates, and they don't find any evidence that companies separate these two types of investments. So therefore, this evidence is what we have currently is mixed, and if any of you has anything to share, that would be much appreciated. So with that, I will conclude the summary of the academic evidence on subtotals, and we'll open the floor for questions.
Thank you,
Thanks,
Anna.
Ira.
And as we open, shall I just, sorry, Torsten, I'm just going to launch the polling and
Yes.
yeah.
While you do that, Aida, thanks to all three of you for introducing these changes. There are a couple of interesting questions in the chat that I think, Aida, you will take and allocate to the speakers.
Yes, I've been keeping an eye on the chat, and I think we have a few questions here. So if I just pick one, so there's a question on just what Anna was talking about, integral, non-integral, and the question is a long-term holding company that operates in 10 or more lines of business with different subsidiaries, associate and JVs, and the question is how they should classify their associate and joint ventures, whether they are integral or non-integral. And you know, indeed, this has been a question that we discuss a lot in our outreach meetings, I think in particular in Asia, where this kind of business model is very common, and its definition of integral relies on your relationship with whether there a relationship with the results, you know, whether cash flows are linked. It also relies on your assessment of whether something is closely related to your main business activities, and then there are some indicators, for example, integrated line of business, and this becomes quite complicated, I think, in this scenario that it was it Ricardo asking, because how do you make this assessment if you have 10, you know, different lines of business, and it can be quite challenging. So, you know, obviously I can't answer these types of questions with yes or no. So what I'd say is we have proposed a set of indicators to help with applying this definition, but we have also invited companies that are in this situation to actually look at their associate and joint ventures in more detail and see, when looking against these indicators, what outcome do they get, and is this the outcome they expect, or is there something that needs to be changed as a part of this guidance. So yeah, so I would say very good question there. If I look at some more, so we have a couple of questions that are relating to topics we will cover later. So for example, disaggregation. So I would maybe leave that for later on. We also have a question around direct and indirect method in the statement of cash flows, and maybe just comments on that, because we are not really going to discuss proposal relating to statement of cash flows in detail today. So the proposal is not to remove indirect method, and you know, our discussion with users suggests that actually this is not something that they would like to remove, that they find useful, and that there wasn't really a demand for that. I mean, as a part of this project, we are really just making targeted changes to the statement of cash flows, and we are quite aware in general that there is a demand for comprehensive review of statement of cash flows, and this might as well come up in the agenda consultation that IASB has every 5 years, and the next round is going to be launched next year. So depending on the feedback in that agenda consultation, the board might as well have a comprehensive project on the statement of cash flows that would address that. So I think, did we have another question? Okay, so there's a question from Mohammed asking how these changes would affect disclosures in the footnotes. With more items presented in statement of profit or loss, more disclosures will be required, and this may be more complicated for users to understand, especially those that are not trained in accounting. And I would actually like to invite Peter Hughes, who is a user and who is with us today, and maybe comments on user perspective on the subtotals, and how he thinks this would affect users' understanding of financial statements. Is that okay, Peter?
Sure. I can also say with some joy that I've noticed that there's quite a few people on this particular call that, just like me, have been both in academia and in practice. So if I say something that's out of line, I would prefer that somebody corrects me on that. All right. Now, it's obvious that with your project on defining subtotals, you are really going to the heart of what is an important part of fundamental analysis. And I think the presentation of the subtotals alone will be a benefit to many users, some of them sophisticated, some of them not sophisticated. But I would agree with Mohammed, or I would at least follow up on Mohammed. I think disclosure of why the choices are the way they are is important. And just to illustrate with this integral versus non-integral, JVs and whatnot, this is actually one of the big challenges that users face. Like, we look at companies that are very interrelated, and we want to identify what is the core operations and what is not core operations. If we just rely on the companies doing that for us with two numbers in the income statement, I think this will not be an ideal solution to the problem. It will lead to potentially leeway for companies to play around with this, to obscure the picture of what the real operating performance is. So I do think that if we go the route of presenting more numbers in the income statement, the explanations of those choices that companies have made will be important as an additional set of disclosures that companies will have to provide. So I understand that there will be a burden, perhaps there will be more to read, but I think not presenting that extra disclosure sort of to motivate, for example, why something is integral or not integral will defeat the purpose of having the extra numbers in the income statement.
Thank you so much, Peter. And Thorsten, I think you had some questions as well.
Yes, Aida, thank you. I would like to direct a question to the board members. And this is not directly related exclusively to the exposure graph, but when Anna summarized the research evidence, she also mentioned value relevant studies and studies that looked at predictability of accounting numbers for future performance. I would like to ask the board members, do you consider these types of concepts, these types of outcomes, value relevance, predictability, as useful or as in line with what standard setters are interested in terms of decision usefulness? I'm referring to this old debate that Mary Barth was involved in, and Holthausen and Watts were on the other side of that argument. So does value relevance, for example, capture something that approximates decision usefulness as you conceptualize it in the framework?
Tom, do you want to have a go, or shall I start? Okay, nothing from Tom at the moment.
Sorry, and yeah, sorry, I was muted, but you start and then I'll come in.
Okay. Thorsten, thanks for the question. I think that Mary is on record saying that the academic evidence can be useful and can really help standard setters, but it can't make the decisions for them. So the evidence, we do seek the evidence, and in the same way, academics have to look at it in the big picture, because the evidence is constrained by the way it's been put together, the models that are used and the data that's gone into those models. So the concept, the idea, can be directly related when we think about decision usefulness. So the idea of something being relevant, an item of information being relevant to share price, or an item of information having predictive value, that the concept sounds spot on, and that's, you know, linked to decision useful information. But the extent to which we can go from the evidence to actually making the decisions, I think, is a more complicated process. So we do look at it. It's been great having Anna putting together the literature on primary financial statements, and Tom and I and others have had a close look at what's there. So we have been looking at it, and we have been looking for takeaways. And I think in this project there is quite a lot of evidence, and I do think it is helping us think about what we're doing. And it's one piece of the jigsaw that goes along with all the other work, the hearing from investors, the doing the field work that we hear also obviously from preparers. So the academic evidence adds into that. It wouldn't stand on its own. I don't think we would rely on it on its own, but I think it fits together.
Thank you.
So I'll stop there. Tom, do you want to add anything?
Yeah, I think you covered most of it. I'll make couple of small comments. First of all, yeah, I mean, we try to be evidence-based, and we look for credible evidence wherever it exists. And a big part of the credible evidence comes from academia, and I would include analytic models, I think, can be informative. So yeah, I think we use it, and then we use it, though, along with all our other evidence, including, you know, discussions with all our stakeholders, in particular users. And it's really nice when we get to triangulate, where if users tell us one thing and the academic evidence corroborates it, then we move with greater confidence. So yeah, we do value the academic evidence a lot.
Yeah, thank you.
Hi, so I have attempted to share the results of the polling, which I hope you can see on your screen. And I'll comment about that in just a moment, but I think a couple of more questions have come up, and let's try to answer them. So there are a couple of quite specific questions. One is from Paul asking, did you consider asking companies to indicate the amount of tax in associate and joint ventures? And we often get questions like, why don't you separate equity method and present related items in different categories? And, you know, this is just a reminder, this is a general project. It's not really about, you know, any measurement basis. So it's not really looking at equity method in any detail, would be outside the scope of this project, but IASB has a research project on equity method, and you know, depending on the findings in that project, there may as well be work on this done in the future. And then we have a question from Pengo, and it's about consensus. Is there any consensus on how to define excess cash? Well, not that I'm aware of. If you're aware of any, please let us know, because I think that will be useful information. And this is why in the exposure draft, the board proposes that cash and cash equivalents is a proxy for excess cash. So it doesn't call it excess cash, but it's a good proxy. And this is how income from cash and cash equivalents ended up being classified in the financing category. So I can see comment from Stephen. I'm just going to read it out in case you haven't looked at the chat, everyone. So Stephen says, when reviewing literature, it's important to be comprehensive, and suggesting some experimental evidence. And Anna, I don't know if you've looked at these papers, if you want to comment on this, or we just take this into account in finalizing literature review. Don't know if you have any comments.
Yes. Well, thank you for this comment, Stephen. We do, as Tom mentioned earlier, we look at different types of papers, not only empirical, but analytical and definitely experimental evidence. In fact, I have these two papers in the literature review. So we are trying to involve all types of areas, not just empirical, but thank you for pointing these out. I have them already included, but perhaps if you have to share your reflections on them and your view how they relate to the project, I'll be happy to receive any comments later. Thank you.
By the way, let me maybe just quickly step in as a moderator. So we have two more interesting sections to go, and we're running a bit over time. So let me maybe propose that all the questions that have not been answered so far will be captured by us, and we would be happy to have you send them by email to Anna to discuss after this event. Is that consistent with Ada, how you wanna run this?
Thank you very much, Thorsten. I think we got one very popular question about EBITDA, but I would say we might as well cover this question later on when we talk about proposals relating to management performance measures, because they are related. So maybe, Mark, if we can just pause your question until we talk about MPMs, and then we can answer, you know, what the board thinking was about EBITDA. And also Josh's question, I think, relates more to proposals on disaggregation. So if okay, I'll just quickly, I've shown the results of the polling, and maybe, I don't know if I want to invite you, Anne or Tom, if you want to comment on the results of polling just quickly.
Anne, do you want to do this, or?
Yeah, thanks, Tom. So operating profit, it's great to see polling strongly for support of operating profit, because that is what we're consistent with what we're hearing from investors. It speaks to the key point about the proposal that Aida's already mentioned, that there's more structure on the face of the income statement. And so people in our audience today are also supportive of that. And then diversity, about whether this line item, the subtotal, the separate line item for integral, associates and joint ventures, and then the additional subtotal that would come if we have that as a separate line item. And you can see that there is some support there, but not as much. And similarly, that's reflected in question 2, whether integral or not integral, non-integral, is going to be useful information for users. I might just pause here on this poll and see whether Peter Use wants to say anything about integral or non-integral.
Well, I think I made my point earlier. I think
Okay.
it's one of the big challenges that we face as users of financial statements, especially you start your exercise and you want to split the company into operations and financing, right? And so thinking about where the associates fit is a big challenge, especially in the part of the world where I live now. So again, I applaud the move forward to providing more information on that, but I do think it comes with the additional burden of having to get a lot more information and footnotes to make sure that the interpretation of whatever goes on the income statement can be done appropriately.
Okay, thanks. Tom, did you want to add?
No, I think we should move forward and cover some of the other areas.
Okay. Aida, back to you.
Good.
Thanks, guys. Thorsten, were you coming in?
No, I wasn't. I was just gonna introduce a second section. Please go ahead, Aida.
Okay, thank you very much. And subtotals generally generate most discussions in all our outreach meetings. So I'm not surprised we spend perhaps more time discussing that. So the second set of proposals on disaggregation, and this slide gives us a bit of an overview of what the whole range of proposals we have, and it's really in response to, and I think one of you made also comment in a chat box earlier, in response to users say that the way information is grouped in financial statements often doesn't give them what they need for decision making. Important, relevant material information can be obscured, as you know, there's not enough detail sometimes, and this is really a range of proposals that have both general proposals and specific proposals with aim to improve how information is grouped and ungrouped in financial statements. So if we look at some of the general proposals first, so if we maybe easily go to next slide to illustrate that. So first we have a proposal relating to roles of primary financial statements and the notes, and this is really to help companies decide what information to include on face and what to include in the notes. And then supporting that, we have proposed a set of principles for aggregation and disaggregation to help companies decide how to group and ungroup information in the primary financial statements and inside the notes. And the objective is really to help them identify material information. And this is really, lots of this is based around a shared characteristic of information and encouraging companies to look at various characteristics and don't stop, which we often see in practice today, or say this is measured at fair value to profit or loss, so I bundle it all and this is all one item in the note and I don't have more information about it. But it's to encourage companies think, if there are different risks associated to these items, then maybe I need to separate further to give users material information. So this is really what the principles are trying to do, and this is one of the few areas of the projects that would affect the whole set of financial statements. So the focus of the project is on profit or loss, but these principles are meant to apply across the statements and across the notes. And we're hoping across the statement of cash flows as well, because we get lots of feedback that disaggregation there also can be improved a lot as well. And in addition to that, we have some specific guidance to deal with the problem, what we say problem of other. And users have told us, and we have seen in financial statements, that companies often use this label other, which, you know, is quite understandable. I would say sometimes when you have lots of immaterial items, you need to put them there somewhere. But sometimes this other can account for significant proportion of the note, and then there is no further explanation. So we have some specific guidance proposing to companies to look further and see if there is anything material in this other, to separate it out, and if there isn't really anything material, then give users a little bit confidence about this number by describing, saying the type of things that are in there, what's the single biggest item in there, so they don't have to keep wondering, you know, should I worry about this or not. So this is on the principles. And then we have some on specific proposals. We have proposed few new additional minimum line items. So minimum line items that are already there in IS1 are not hugely affected, but we are proposing adding a requirement to present goodwill separately in the balance sheet, and this really arises from this discussion about different characteristics and goodwill having different characteristics from intangible assets. So proposal is to put it separately, and then also rising from proposals for integral and non-integral associate and joint ventures, we have a proposed separate line items for these, both on the balance sheet and in the income statement. And then we have two more proposals, which are start on next slide, which are really where most of the discussion, I would say, around this segregation arises. And first relates to the analysis of the expenses, operating expenses, on the face of profit or loss. So just as a reminder, so companies, what they do today, there are two ways by which they analyze expenses in the P&L. So one is by nature method, which is companies present various inputs used in their processes, so staff, depreciation, and the like. And the other one is by function method, which allocates these expenses to different activities. So for example, cost of sales, research and development, selling costs, and so on. So the board is really not changing this hugely, but proposing to strengthen these requirements in several ways. First is that to clarify, this is not a free choice which method you use. So you need to you as a company would need to assess which method is most useful in your circumstances, and ED has some indicators to help companies decide that. For example, how you manage costs internally, what does your industry peers do, and the like. And then whatever is deemed most useful, you do that method. And then second one is you should not mix the two methods, in that, you know, if you do by nature, you should do by nature completely, or if you do by function, you should do by function completely, with the exception of minimum line items which are required regardless. And the reason for this not mixing is to ensure completeness of information for users, because what we see in practice today, sometimes companies would present cost of sales and then they would have depreciation as a separate line item. And then users wouldn't really know whether cost of sales excludes depreciation or whether depreciation line item excludes depreciation relating to cost of sales. So it's not possible for both of these line items to be complete, because then things wouldn't balance, but it's unclear which one is incomplete. So to avoid these issues, the proposal is you do one or the other, with exception of minimum line items when we know minimum line items have to be complete. And then the final bit is that the companies users have told us that regardless of the method company uses, information by nature is always useful to them, because it helps them predict future cash flows. So when they look at predict future cash flows, they would use information by nature. They tell us they use by function information, for example, to look at margins. So the proposal is that all companies that present analysis of expenses by function on face would be required to have a note disclosure that would provide analysis of expenses by nature of inputs in the notes to give this information to users regardless. So we have a little bit controversy, I would say, about this proposal from some companies that do not do analysis by nature today. And for them, some of them think because their systems are not adapted to it at the moment, it would involve some work and changing of the systems to provide this information, and they are worried that this could be costly exercise. But then on the other hand, we have lots of companies that do this today as well, and they say they have no problem with doing that. And it's maybe a good time to emphasize we have about 50 companies doing field work at the moment, so testing these proposals, and this is really going to provide important input to the board in assessing whether proposals work as expected or whether we need to make some tweaks or changes in finalizing the standard. And then finally, on the disaggregation, just a few words around proposal for unusual income and expenses, which is on the next slide. And this really arises from the need from users about separating information about income and expenses that have a less predictive value than others, because again, this is useful for forecasting future cash flows, and this information is used differently depending on their predictive ability. And companies sometimes disclose this information today, but it's unclear to users how companies decided what's usual and what is unusual. And it's also often users tell us they tend to put only expenses there, and we hardly ever see any revenue classified as unusual. So the proposal is in the exposure draft that all companies will be required to identify unusual income and expenses if they have any, and they will be required to provide a note disclosure about these items in the notes, and also attributing which line item in the P&L they relate to. And it's not just limited predictive value. So you can see here on top of the slide, there is a kind of bit of definition behind it to help companies determine what is unusual. So when it's reasonable to expect, so it's based on future expectations that income and expenses are similar in type and amount will not arise for several future annual reporting periods. So the idea is that you don't just focus on next year, but you look at few years ahead and you consider, is what I have today, is this likely to recur? And if it is likely to recur, is this going to be similar amounts, or is it going to be largely different? And use that to make a judgment on what is unusual. And as you might expect, there is a bit of discussion around this as to how easy it is to apply in practice. I'm encouraged by our results from fieldwork so far. And after Anna has gone through our academic research on this topic, I will launch a poll, and I'm interested in your views on these two topics. So with that, over to you, Anna.
Thank you. So on the question of disaggregation, the academic evidence shows that finer disaggregation, increased disaggregation is associated with higher informativeness of the statement of profit or loss. And there is a study also which shows that disaggregation based on materiality thresholds increases the reliability of the statement of profit and loss because it reduces auditors' tolerance of misstatements. There is also some evidence that because of the increased information environment, the increased disaggregation is associated with better forecast properties of analysts and also a reduction in the cost of equity capital as well. So all in all, this provides some support for having clear guidance on disaggregation. On the question of related to the proposal on reporting analysis of expenses by nature versus by function, the evidence here is limited, or at least what we've come across. There are a couple of descriptive studies which examine companies' practices of reporting analysis by function versus by nature, and they show that there is the practices vary widely, and sometimes companies do use a mixture of these two methods. So one of the studies also looked at what determines the reporting by nature versus by function, and showed that the choice is driven largely by the country, by the industry the company is in, and to some extent by the auditor. So this suggests that because of this wide variation, the comparability is potentially compromised. So again, some guidance on how to do this choice seems to be supported. And finally, the literature, what the literature review revealed on unusual items. Of course, the studies have used various names for it, non-recurring or special items, etc. But what emerges from the literature is that these items have very different time series properties, and therefore they're quite important for forecasting purposes. And sometimes managers tend to misclassify these special items, and it is not actually clear. The evidence is mixed on whether investors can always appreciate these misclassifications, but in the absence of such strategic classification of special items, it is certain that these items are non-persistent, which again highlights their important role for forecasting, and therefore shows that defining them clearly would be beneficial to the users of the financial statements. So this is, with this, I will again open the floor. Well, first the polling and then the questions.
Thanks for that, Anna. And then, as you've seen, I've just launched the polling. We have 3 questions here. Focusing on analysis of expenses and also proposed requirement for unusual income and expenses. So I'm just opening chat box for the questions. So I can see Thorsten has a question. Thorsten, would you like to ask a question?
Yes, please, Ada. Thank you very much. Of course, in times like this, the question cannot be avoided. If we're thinking about events like the current corona pandemic, would this, in your view, qualify as an unusual item, and how would companies go about separating something like a corona impact on the P&L from other items, including how long would a company be justified treating items as corona related? And what about expenses versus revenues? Is it possible that a company could in some way, let's say, provide information about what they think sales would have been absent corona?
Thank you, Thorsten. It's a very topical question, isn't it? And I'm happy to answer it. I just want to see if Anne or Tom would like to comment first.
Tom, it's your turn to go first.
I think, well, okay, at some risk, I'll go first. I think the way we defined it would work well for something like the coronavirus pandemic, because we basically say that it is unusual, and with respect to, you wouldn't expect income or expenses that are similar in type and amount in the future. And clearly this is going to drive the amount of sales in a radical way for some companies. So I think this would probably pass as unusual under our definition. But again, not for all companies, because if you're a grocery store, you're actually selling modestly more, probably not unusually more. So we do leave room for judgment, but it's expansive in that it didn't simply say it's a really unusual event like a volcano blowing up. Okay, so I think it will be helpful, and it will manage things like the coronavirus better than something that focused only on sort of unusual events.
Thanks.
Thanks, Tom. If I can maybe just add a couple of points, and you know that this really does come often in our outreach. I think, Thorsten, to your second part of question, if you know, so with revenue, you know, you can have supermarkets and or smaller stores like Tom was mentioning that might need to consider whether the level of revenue we had is more than we expect going forward, and whether to classify or, you know, disclose any of that as unusual. And then the second part is the revenue I didn't have, but I would have had absent corona. And, you know, we have seen some companies using EBITDA measure that would include such a revenue. So this certainly would not be possible with the proposals for unusual income and expenses, because these relate only to recognized income and expenses. So if, you know, and this wouldn't have been recognized as in the first place, so it couldn't be designated as unusual. And then maybe just finally, as Tom said, it very much depends on the judgment. And with effects of corona, some of these effects are what people call as new normal, perhaps, and things that are likely to continue going forward. So even though you might have had effect that was different from past, you know, this effect might persevere in the future. So it will be very much dependent on the judgment whether, you know, similar items will recur in several future reporting periods. Whereas there are some things that are genuinely, you might consider, okay, I've had this one-off. We have had one of these one-offs in our office where, you know, our office manager has very kindly sent us all chairs, proper chairs, and, you know, desks to work on at home. And, you know, this is one-off expense, because even if, you know, crisis continues, we continue working from home, they're not going to keep buying us chairs and desks every year necessarily. So I think, just in conclusion, I don't think unusual income and expense is ever designed to give complete picture of effects of something like corona. And I'm not even sure that that is even possible. I think some regulators have already commented that they much rather have companies provide narrative description of effects rather than try to quantify, because it's really difficult to quantify all of it, because you have what happened, also you have what didn't happen, you also have your cost savings and the like. So that is what I want to say on that. So I'm just looking at the questions come in. and see what we have. There was a question from Mohammed that I'm not sure I quite understood. Mohammed is asking, disallowing mixing between function versus nature may prevent application of materiality. Auditors may stop management from presenting materiality account based on materiality if management are using function for presentation in profit or loss. Are we able to bring Mohammed in to maybe explain his question? And if that's not possible, maybe I ask.
Yes, can
yeah.
you hear me? Can you
yes,
hear me?
We can hear you.
Yes, hi. What I mean, when they present to the P&L based on your proposal, then the idea, if they are following the function, sometimes there might be a transactions which may affect a particular account, which will make it material, and therefore management may decide to try to have a separate line to disclose it. So at that time, if you are disallowing the mixing, then auditors will stop management from doing that, telling them that they will be violating the requirement of the accounting step. This is the idea. Thank you.
I understand. Thank you so much, Mohammed, for explaining that to us. Tom, Anne, do you want to comment to this, or shall I comment?
Go ahead.
Okay, I assume that's meant for me. So I think you're right in saying that this would stop companies presenting different or separate additional line items in P&L, and we have had lots of feedback on that. Is that sometimes separate presentation of line items, such as, for example, goodwill impairment, would indeed be useful on the face of P&L, and this wouldn't be possible applying the exposure draft proposal if entity presents expenses by function. So I think I explained previously why this proposal came about, is to avoid this question about completeness of items either by nature or by function. And clearly we have guidance on disaggregation that should help further companies identify these material items and then disclose them in the notes. So the presentation doesn't end with your allocation to function in the P&L, and the expectation is that companies would use this guidance and then further disaggregate, perhaps, and show additional information about composition of particular function and highlight some of the material items. But I just want to add that I think this is one of the topics in general that we will probably have to bring back for discussion with the board, in particular whether there are some additional items that are always useful to investors and that maybe shouldn't be allocated to functions, because we hear that things like goodwill impairments are quite difficult to allocate to functions anyway, and the question is whether that should be done.
Aida, I'll start on the question for Ricardo. I haven't read his second part, but I've read the first part. Ricardo says that in our requirements, we are saying if an entity is doing by nature on the face, they don't have to do by function in the notes, whereas the reverse is true. If you go by function on the face, you do the disaggregation by nature in the note. Now, Ricardo is suggesting that perhaps that what we observe, we say that he is putting forward the idea that analysts are not demanding the by function in the notes because most companies are doing by function on the face. Aida, I just wanted to speak to that because I know in our conversations what we have found is that the dominant presentation varies across jurisdictions. So there are some areas where it is true, as you say, Ricardo, that most people are doing a by function. And for example, there are some areas in Europe where that's true, that the majority of companies are doing a by function presentation on the face. But it isn't true across all our jurisdictions. There are other places where there's diversity, and there are other places where companies have, or sectors where companies have a preference for going by nature. So I just wanted to pick up on that first part of your question. Aida, I don't know if you've had a chance to read that second. I haven't read that second part yet. I don't know if, or Tom, whether you've had a chance to look at that second part of the question.
No, I haven't, although it might be good to get Peter's thoughts on function nature.
Well, I can only repeat at this point that it depends on where you are, I suppose. And I've in my work, I've been, we like gross margins and things like that. So this is kind of the thing that we've been focusing on our work mostly. But it's clear that a pure solution here with only function would take information away that we need as well. So the way you presented it with having both types of classifications available, I think that's the way forward. And I cannot make comments on how you should sort of split it up, like whether you make one mandatory on the face of the income statement and another one in the disclosures. I just think that both types of information are incredibly useful and they complement each other. So that's what people that, especially in the forecasting world, that's what we need.
Thank you so much, Anne and Peter, on this. And just maybe to add a final point on this question, I think it's true there is not, well, some users, I think like Peter perhaps would like to see this for everyone. This hasn't been the case overall, but there was another factor behind this, and that is that if companies are not already allocating expenses to functions, there is a risk that requiring allocation to function could be quite costly and even more costly than information by nature for those companies that don't have by nature, because nature you have captured somewhere in your system, but you might not have it consolidated. But if you don't do by function, you just don't have it. You have to make it up completely, and then in doing that, there is also risk that it could be purely arbitrary allocation in cases of some companies. And certainly, if this would be arbitrary allocation, then it can't be useful to investors for margin analysis. It can even be opposite of useful in those circumstances. So this was also part of the reason that the proposal didn't go both ways in that. So I'm just going to end polling, and whilst I'm doing that, maybe hand over to Torsten to see was there any questions we didn't cover on this topic, or if he had any more questions before.
Yeah, Aida, can I just respond on the extraordinary or exceptional items one that's just come in? So from Christian Stadler about exceptional items. So we used to standard setting removed abnormal items and exceptional items. So Christian's pointing to that. We did have exceptional items and they're gone. So are we going round in circles by bringing back unusual? Thanks for the question. It's a good one and it gets raised with us. With the unusual and the way we're defining it and the way we're dealing with it in this proposal is that there are some items that companies do want to highlight, and by using the putting the unusual category there, we're giving people the ability to highlight items, but they are still within operating. It's not like it was with abnormal and exceptional, where entities would take it right out. The unusual still belongs in its category of operating. Aida, have I got that right? Do you want to add anything there?
Yeah, no, that's absolutely right. I think that's the key point, that it's not treated as something out there, net of tax, net of everything, completely separate. But this is really, it's recognized that unusual items happen. They are part of your business, but then, so they are captured in respective categories, but then users want information about this, which is why the note disclosure is proposed. Thank you. So now, Torsten, to you.
Yeah, okay. So maybe a couple more questions. I also want to add that Ricardo's second part, which he wrote directly after the first one, is basically consistent the way I interpreted Ricardo with Peter's answer that, well, those two sets of information are really complements. And Ricardo's proposing that there should be a symmetric treatment of by function and by expense. One goes in the notes, one goes on the face, similar to what Anne was already commenting on. Let me take two more questions by Jim and Mark. Jim says, hyperlinks make this aggregation much more sensible and less costly these days. That is an interesting point, and it resonates with me because it seems like we're still thinking about the financial statements as a paper document or a PDF document, whereas nowadays, of course, digital transformation and the way information gets presented might make things much more flexible.
And maybe this is an opportunity for me to invite Anne to maybe just comment how we considered this project in the light of electronic reporting.
Yes, again, great point. Look, we've all been in areas and used the hyperlinks, and they are just so helpful and so useful for scooting around. And some people are really presenting interactive annual reports, which are just great. So we did try to push ahead with this, particularly with the principles of disclosure discussion paper, you might recall from a couple of years ago, where we tried to explore how much cross-referencing we could do, and hyperlinks would be part of that. We had to just slow up a little bit on that, because not every jurisdiction is the same in what documents need to be filed and with whom they need to be filed. So while in theory hyperlinks is way forward and making greater use of the electronic presentation and electronic connectivity, we haven't especially pushed forward in primary financial statements on this because of a lot of information we found out in principles of disclosure from regulators. So there needs to, our standards need to work in various countries, and that needs to fit with how the regulators view the documents and their legal requirements around documents. So we've had to go quite slowly on this, even though some of us were very keen. So yes, in theory, and yes, there's lots of potential there, and hopefully we will get to do more on this, but we haven't pushed forward as much on primary financial statements as we might have or might have liked to, just because of practicalities. Thank you.
Thanks, Anne.
Mm-hmm. We have one more question. Do we have time? Do we have time for one more? I'd like to take Mark's question here, because Mark had a previous one and didn't get through. This is interesting. Some non-recurring items play an important accountability role, even though they may not be likely to recur. That is, forecasting is not the only role of information and also disaggregation, it seems.
Do you want me to comment? Maybe I'll comment on this. As it's Tom. As Aida said, we put the unusual in a note which lets users incorporate it if they wish to, if they want to, in other words, take the operating profit and pull out some unusual items. One of the reasons that we did that is for precisely this reason, is that it does allow managers to be accountable for operating profit, including everything that's happened. And so non-recurring items are really important in accountability, because when you forecast forward, a lot of the times these non-recurring are negative, and they're not part of your forecast, but they're very much part of the accountability. So I think it's consistent with what Aida said about why the unusual is in a note.
All right.
Thanks, and I will share the polling. So I managed to, of course, press the wrong button, and instead of sharing polling, I cleared the polling and I relaunched it. But thank you to audience for cooperating and for quickly repopulating it. So from my memory, I don't think results are hugely inconsistent.
Aida, may I step in just quickly? I actually took a picture of the final poll. Would you like me to share my screen and show it?
Yes, why don't you do that? Thank you so much.
Sure. I hope this is somewhat visible. So let me just see which screen it's on. Can you see this? No, you can't yet.
Not yet. No? Something is happening. Yeah. Okay, wonderful. Saved by the team. Okay, so Tom, is it your turn to comment on these results?
Actually, I'm having a hard time reading them, so perhaps you should.
Okay. Okay, fair enough. So we had two questions about expenses, nature, function, and the first one is around the mix, and there were mixed views, and I think that's kind of consistent with what we've been hearing, that there seems to be in total like agreements with prohibiting mix, but then there was 48% of you said that maybe additional line items should also be considered. So I would say that's quite consistent with what we've been hearing in the outreach. And then second question is just around requirements for analysis of expenses by nature and notes, and majority of you support that proposal. And then we had a question about unusual income and expenses, and majority of you said you agreed with the proposal as it is. So that's really good to hear. So with that, I will ask if we have any more questions on this topic. If not, maybe invite Anne to guide us through the management performance measures proposals.
Thanks, Ada, and we'll go back. If Thorsten, if you take your screen away, and we'll go back to Peter, who's sharing the slides for us. Thanks, Peter. So management performance measures, many of you are familiar with that sort of non-GAAP performance metrics, might be under the name of alternative performance measures, and these are complementing their IFRS results. So the alternative performance measures are used, we're told, because it allows companies to tell their story in a more specific way. And so research and our outreach tells us that the use of APMs is quite prevalent. AIDA referred to the sample of 100 companies that is referred to in the exposure draft. And in that sample, at least around 90% of them presented at least one MPM. So that's something like underlying profit or an adjusted EBITDA measure. We know from our work that investors find MPMs useful. But equally, investors have also told us that the information quite often is not transparent. It can be difficult to find, and sometimes it's changed from one period to another. So in our proposals around management performance measures, we're looking at a subset of these alternative performance measures, and we're proposing that they would be inside the financial statements in note disclosure. And this would enhance the transparency of them and indeed the discipline around their presentation. So on the slide now that you can see is how we're proposing to define management performance measures. So firstly, there are disclosure in the notes of subtotals of income and expense. And they've got three elements to them. Firstly, MPMs are something that the entity uses in public communications. They're outside the financial statements. So it's presently appearing in a press release, investor presentation, management commentary, something like that. The second aspect is that this disclosure complements the information that's coming through the subtotals or totals that are specified in IFRS standards. And the third element to it is that the disclosures about communicating management view of the entity's financial performance. And so this means that not all the things that appear in the public communications are MPMs. Our focus is on the ones that communicate about performance. So considering our proposals, if an entity communicates its performance only using IFRS specified totals or subtotals, then the entity is not presenting a management performance measure. So what do we mean by these IFRS specified subtotals and totals? Well, we're talking about the three new subtotals that we saw today on the slide. Earlier on in this slide deck, you can see the new subtotals. The other things that would fit in gross profit or something similar to that, operating profit before depreciation and amortization, profit from continuing operations, profit before tax, profit or loss, total other comprehensive income, and comprehensive income. So in summary, we're talking about the subtotals or totals that are already required in IFRS standards and the subtotals and totals that appear as a result of the new proposals that we've got in this in our ED. Okay, if we can go to next slide, please. Right, this slide shows for us the scope that we're looking at. So the point here is that not all performance measures are management performance measures. So, sorry, not all APMs are management performance measures. So when we talk about management performance measures in our proposals, we're talking about a subset of non-GAAP or a subset of alternative performance measures. So looking at the left-hand side of the slide, non-performance measures are not MPMs. So these are things like numbers of subscribers or a customer satisfaction score, something like that, non-financial. They are not in the category of MPMs. Secondly, IFRS specified measures are not MPMs. And I just said that a minute ago, and you can see that in that second box there. IFRS specified totals and subtotals are not MPMs. And then just looking across to the final column on the right-hand side of the slide, there are measures that are not subtotals of income and expense, and these are not MPMs. So things like free cash flows or ratios like return on capital employed, these are not within our definition of MPMs. So you can see that slide summarizing where the MPMs fit, and there they are in the box with the dark green outline. Now, we don't propose specific restrictions on the calculation of MPMs, but they do have the overarching requirement for faithful representation, being understandable and not misleading for users. So looking at the next slide, we're proposing disclosures in the notes. Now, some of the proposed disclosures are largely consistent with what securities market regulators already propose or require in their guidance. So, for example, ESMA has requirements, and other regulators as well, around reconciliations. So we're proposing a reconciliation of the IFRS, of the management performance measure to the closest IFRS subtotal or total. Regulators in their guidance already require things like clear labeling and explanation of how the measure is calculated and any changes in that measure compared to last year. A third thing that is commonly required or in the guidance statements is that a statement from the entity saying that MPMs are not necessarily comparable between entities. There are some new requirements in the ED. For example, we require additional information about the income tax effect and the effect of non-controlling interests. And we're requiring that separately for each of the adjusting items. The reason that we're doing that is that there's complexity across different jurisdictions because they have different tax rates. So we don't specify how the tax effect should be calculated, but we just require entities to adopt a method that seems appropriate. So we're requiring this information about income tax effect and the effect on non-controlling interest so that analysts can see that in relation to individual items and they can adjust accordingly, because we know that not all analysts treat the adjusting items in the same way that the companies treat them. So with this additional information, analysts will be able to better prepare their models. The other important point here is that the MPM note would be audited, and that's a change from the state at the moment. In most scenarios, of the non-GAAP or APM disclosure. So if we could go to the next slide, I think that that's been covered. That's where I'm just talking about the improvements that we think will arise from these proposals. And I'll just quickly recap. It's the location. They'll be in a single location and therefore much easier for people to find where they are. They've come within the scope of audit. There will be some specific disclosures required, some that are already done by companies, but some new ones. And we're hoping that the proposals will improve the consistency of management performance measures between entities, irrespective of the jurisdiction in which they're located. So next slide, please. And I think we're up to talking about the literature. So I'll hand over to Anna. Thank you, Anna.
Thanks, Anne. So the literature on non-GAAP measures is quite vast. So I've tried to summarize it here with a few bullet points. It is, as Anne mentioned, these measures are widely used by companies, and the general agreement in the literature is that they are value relevant, they're useful to investors, and their disclosures often reinforce the usefulness of the traditional GAAP measures as well. However, in the absence of specific guidance on how to define these measures or when to disclose them, what is observed is wide variation in the definitions of these measures, and also managerial motivations vary for when and the purpose they disclose these measures for. For example, sometimes managers disclose them in order to portray a better picture of the company's performance, but there is evidence that other times managers disclose these non-GAAP measures with the intention to potentially mislead investors. So this all points to the need of some guidance with regards to these measures. And also there is evidence that sometimes these measures are not transparently defined. There are no clear reconciliations to the underlying GAAP measures. So some studies have actually shown that when the measures are more transparently defined and when they are reconciled fully, then this increases the relevance of these measures, but also the informativeness of the financial statements in general. So I will stop here. As I said, this literature is vast, but I've tried to extract just a few lines from it, and I will pass over to Aida for the polling.
So I've just launched polling. We have one question on management performance measures, and whilst you're answering that, I want to ask Torsten if he has any comments or questions on this topic.
So I do have a couple of my own, but I'd like first to take a look at the chat. I've been trying to keep track. Some of the discussion in the chat was still revolving between Katharina and Jim about disaggregation and hyperlinks. But that doesn't relate to MPMs. One question that I'm getting is from Luis. He says, financial performance measures could be developed by activity sectors and presented in the notes. So I think he's hinting at sector-specific KPIs, like for example, in the real estate industry, where we have net asset value or earnings per share as defined in these industries. What is your take on that?
Thanks, Torsten. I'm happy to comment on that. I think it's a question we get in the outreach as well, and you know, like you said, there is some sectors that have developed their own measures, but I think the experience of working on, for example, developing proposals, how they would apply to a bank, the first approach we considered was to define banks and simply say they put these things in operating. But then it was like, what is a bank? How do you define that? you know, what do you do with these companies that have multiple activities? So it's a very, I think, challenging to square companies into these sectors when, you know, business models are so varied, and it's a very, you know, companies do multiple things, as some of you have commented on when we're discussing integral and non-integral. So I'm not quite sure as a standard setter here that would have been feasible option, but as you note, there is, I imagine there will be a sense of probably some kind of harmonization on sector level in terms of the measures that are disclosed already today, and then these measures will be captured in the financial statements. And with that, I just want to see if Anne or Tom would like to comment on this question as well.
I think you covered it well, Aida.
And I think we had a question on EBITDA earlier on at the beginning of session, and I think it's a good question. I think worth. I just want to see if Anne or Tom, you would like to comment on the board discussion on EBITDA, or do you like me to do it?
Well, one of us could go. Anne, do you want to do it, or do you want me to do it?
Anne got disconnected. She's trying to get back.
Oh, okay. All right. I'll just say something. We did look at EBITDA. The problem is that most entities that do it as a alternative performance measure do additional things besides the literal earnings before interest, taxes, depreciation, and amortization. And there are all sorts of variants on this. And so we decided that if we were to do it, we would probably need to be literal. But then also, if we tried to do it literally within the way that we've structured the statement of financial performance, that would be very difficult. For one thing, it doesn't fit nicely with a functional presentation. So in the end, we did put in a new subtotal that you can insert into operating, and is a subtotal. It's a voluntary subtotal, which Aida will correct the name, but it's operating before depreciation and amortization. So you can do this if you like. But we thought that was the best we could do without sort of damaging many other things that we wanted to try and do. So we expect that by in the MPMs, it will still allow entities to use some kind of adjusted EBITDA or something if that's what they want to do.
Thanks, Tom, and really it was quite interesting because we spent quite a lot of time, and there was interest among some board members at least to try to pursue this and try to define it, and we spoke to lots of users about it, and it was clear there was no consensus of what EBITDA presents. And we couldn't, because, you know, to define something you need to have some kind of principle, objective, what is it you're trying to define to help you guide the decisions. And as Tom said, apart from this literal meaning, you know, there was really no consensus, and it was clear that users also didn't want this literal meaning because they also wanted to exclude, for example, share of profits from equity method accounting. So it was and, you know, define something without objective of what it is you're defining, it's really not what standard setting is about. But, you know, EBITDA is a very topical issue, and maybe at a danger of, I'm not quite sure what Peter's view on this is, but I would dare and invite maybe Peter to comment about his views on EBITDA.
Well, I'm not going to comment necessarily on what I think of EBITDA. Well, I can be blunt about it. I don't like it as a metric, but I do appreciate that a lot of people out there use it as a proxy for both earnings and cash flows. But to comment more generally on what you're proposing, I think it's very important that you are making the MPMs, which typically have the word adjusted in it, and this is what Tom was hinting at, you are proposing to make them part of the financial statements, which is a very big deal, right? Because it brings them under the remit of the auditor, and it brings them also more in terms, more forward in terms of visibility towards other users of financial information. I've always been a fundamental type user of information. So for me, working with adjusted metrics actually was kind of what I had to do. So that's why fundamental analysts appreciate these metrics, because it helps them on the way to do their homework, if you wish. But there's a category of investors out there that actually is not a fundamental investor. And I think at present, they are struggling more bringing these adjusted metrics into their analysis, because the information is not always there to make the connection with the GAAP or the IFRS type numbers. And I think bringing that into the financial statements will allow these quant people hopefully to better integrate some of these metrics into their analysis, and that hopefully will emphasize some of the findings that academics have already established, that these metrics are value relevant, but we will just get more transparency on them now. And I noticed that actually there's a couple of good questions in the chat that speak to these issues. We need to get a view on consistency. We need to get a view on comparability. And again, by bringing these metrics and their reconciliation into the financial statements, hopefully that will contribute to those two aspects of these metrics.
Peter, maybe I can link this this final sentence you just said about consistency and comparability to a question in the chat. This is from Luisa, who points to a paper by Black and co-authors, which is a very well done paper, I think, which is also mentioned in Anna's overview. And she wonders whether and how consistency, so across time comparability and comparability across firms, how those important aspects in the MPM realm, how those might be affected by the new proposals once they become effective. And that probably also raises a transition requirements issue.
Ada, I'll have a go at responding to Thorsten, and following on from Peter's excellent comments and Louisa's question there, consistency and comparability. So Peter has started speaking to this. You've got to think that entities report within their jurisdictions and they're under different guidance. Some regulators give very clear guidance around management performance measures, and some don't. So the practice, the way they're disclosed, is very diverse. So what Peter is alluding to when in his comments, thinking about the proposals, the idea that you can get increased consistency and better comparability if there are requirements specifically about the proposals. And that's what we were talking about in the slides, where we said there will be requirements for reconciliation. So yes, some people already do that, but not everybody does it. So there'll be a requirement for reconciliation to the closest subtotal or total in IFRS. There'll also be this requirement to show the adjusting items with clarity, so that there can be more information about what has gone into the MPM, the adjusted whatever. So the requirements for more disclosure are there. One of the requirements is about disclosing if it's been calculated in a different way to the prior year. So I think all of those will lead towards consistency, improved consistency and comparability. Thank you.
Thanks, Anne.
Yes,
Tom.
I just add one thing on to what Anne said, is not only do you have to explain the change, but more broadly, you have to do it when it's new, and you have to do it when it's removed, and you have to do a comparative so change embraces new and removed. So I'm not even sure some of the better jurisdictions have that requirement, and that would be audited. So as Anne was saying, I think there's significant improvements on consistency, especially if all the world follows what we've put out.
Thanks, Tom. And as you said, the ED actually has specific requirement that entities cannot just change MPMs from period to period unless, you know, this change is kind of accounting policy change, unless they demonstrate that the new measure is more useful. So in that sense, and then like Tom explained, if they do change, they have to provide explanation and restatement. So that would be better. And maybe just worth commenting on how subtotals would help as well, because MPMs by definition are defined by management, so there isn't comparability in a sense that you know what measure comprises. It's defined by each company as they want. You know, we expect some kind of consistency between sectors, but it's not required. But what the proposals for subtotals do is, I think, and we have done some tests looking at these reconciliations with current subtotals and going forward, is I think they give much more insight into actually what the measure is, and I think it makes it much easier to compare from company to company, because you have these consistent anchor points of operating profit, profit before financing, and other subtotals that would be used in these reconciliations. So I think it will be much more transparent and easier to make these comparisons.
Good. So I think we're doing very well on time. There's one more question that I'd like to bring up from the chat. This is again from Ricardo, and he's concerned about the wording of MPMs and how they relate to management approach-based measures, for example, in the segment report.
Aida, shall I have a go?
Yes, please, Anne.
Thanks for the question, Ricardo. Yes, the board did discuss the relationship between MPMs and would make a requirement that the MPM was reconciled back into the IFRS 8, the segment note. But on balance, the board came to the conclusion that that would just be a step too far, that it really wasn't going to add, it wasn't to make that requirement, wasn't going to add to what could be achieved without it. So we didn't go that far. But we are aware that the subtotals we segment note can in some ways line up with the MPMs. So we'll be interested to see how that plays out. But our focus was getting this better transparency, improving the comparability and consistency of the MPMs. That was our focus. We know that the MPMs reflect a management view, the performance measures that the management want to communicate to add on to the IFRS measures. So in that way, the logic behind them is similar to the logic that's going on in what is presented in the segment note. And we do believe that we will see information that is in the segment note and is also in MPMs. But we're waiting to see how that will evolve, and we didn't think it was necessary to require a reconciliation between the two. Thanks, Aida.
Thanks, Anne, for providing that explanation. I hope you heard it. Anne was breaking at the point, but I think still we could hear her explanation. And I think to second part of Ricardo's question on the term of management performance measure, that may be understood to mean broader set of measures than the ones in the exposure draft. I think the responses to survey also indicate that view. I've just, I hope you can see shared results now where you know, almost half of you agreed with the proposal in the ED as it is, but a quarter of you said the definition may be too narrow. And I think this is maybe, Ricardo, what you were alluding, that when using term management performance measure, you might just lead a reader to expect to find more in there than subtotals of income and expenses. And this is a feedback we've been receiving a lot through the outreach. I think in particular from users, they are keen to have other measures subject to this discipline and transparency that MPMs are proposed to be subjected to, things like free cash flows, things like return on capital employed. But that would take the project away from being complementing to, because remember, management performance measures complement proposals in the income statement for the subtotals, so everything works as a one package. And I think if we go move away and bring a broader set of measures in, then I think the board will need to consider then how do we define, you know, the purposes and objectives, what do we reconcile with the two. So it becomes quite different proposition, but no doubt there will be lots of comments about that in the comment letters that we will need to discuss with the board.
That's a nice wrap up, I think, Aida. Would any of the panelists like to add any more comments? Otherwise, I think we're perfectly on time and almost ready to wrap up.
Thanks to Thorsten and EAA. Thanks, Peter Hughes, for joining us today. But thanks to EAA and Baha, Thorsten, and the people that have organised it. It's been great to be able to talk to people through this forum. So thank you very much.
Thanks on our side. Thanks to all of you on a Friday afternoon for making yourselves available and sharing your insights with us. Let me maybe point all of you in the audience to our Accounting Resources Center, where more virtual events by the EAA can be found. If you want to keep an eye on that, please check back regularly with the Accounting Resources Center, where we're going to announce what's going on over the summer and in the fall. All of you have a very good summer. In this special situation, it's even more important to get a bit of a break, and hope to see you again soon, preferably in some physical format. All the best. Thank you.
Thank you.
Thank you.
Thank you. Bye-bye.
Thank you.
Thank you.
Bye.
Bye. Thanks.